This is Friday, the 21st of November, just after close, 16:45. And I don't have a very specific thing I want to go through on this video other than just look through some of the price action from the week. I was doing a bit of a top-down analysis last night and got a few insights into how the week played out that were very, very nice. There were a couple of really nice trades that I should have been a part of just this afternoon for the PM session of New York, such as a short from right here down into these lows, and I was stopped out perfectly before it dropped in my direction, tripping in my take profit, and so put me on the wrong side of the trade and ended up having a fairly red day. I also did not execute very well this week. As you can see, I'm not too proud of it, and I'll show my executions later on. But yeah, it's been a bit of an interesting week. One thing that's really stood out to me was on my personal accounts with a forex broker trading CFDs. I had to look at the equity curve over the course of the last few weeks, and it just really is not looking very good. It's in a bit of a bear trend, you could say. And it's not because my strategy doesn't work. Like, I've got a lot of incredibly good entry models, and as you can see, like, I should be catching plenty of really, really big wins, such as this right here. This should have been at least a 3-4 hour win. And then if we jump across to gold, in fact, I can even show it over here. If I jump to the practice account, you'll see that this is nice and in the profit at the moment. I do show executions and jump over to gold. This is the trade that I should have been a part of on my personal accounts. And on my personal accounts, there was just one small thing that threw me off, and then it never gave me a re-entry, and so I missed out on this big run lower. So I'll talk through why I saw this short and why I think could actually be like a fairly long-term high for us to sell off a lot lower into the range. So yeah, let's just jump into that. So I'll start off on gold on the high time frame. We'll do a brief top down, just looking at the daily here. So this is the Friday candle from last week at the close. As you can see, we sold off on that Friday with a large down closing candle. We've got a lot of smooth lows down here, and I'm expecting us to draw down into these lows. However, after a big sell-off like this, my standard operating procedure is to 1, wait for us to engineer a high to raid, 2, entice lower, 3, attack that high to take out any trailed stops. You can see that a lot clearer on the lower time frame, that sequence did in fact play out. That's Friday closing with a really long wick on the low, a lot of sell side below there. And then Monday, or the Sunday, opens up, engineers relatively equal highs, so engineers a buy side pull. We can draw out a line on that, which I thought I already had one, but yep, we'll just draw a line there, so that's Monday's high. So first engineers a high, 2 entices shorts. You can see a 3 drive pattern into these lows with a first drive making a really long wick, and then a second drive on the 2200 4-hour candle, then 2 a.m. opening up, making that low and reversing. So 1, 2, 3 drives, rallies back up into the range. You can see that this is actually at a premium of the range as well, and the key is that it closed above the premium, above the mid portion. So I trust that this high is now in place, an intermediate term high. So that high should not be taken out if we are bearish. It breaks low and then begins working its way lower. And you'll notice how we have Monday's high that we revisit the next day. So we take it out on the Tuesday, and then on Wednesday at 1800, and then again on the 6 a.m. 4-hour candle, we work back above that same old high. Now that the fact that we reject from that is a bearish indication. On the 1 hour, I'm sorry about the abundance of drawings everywhere, but I'll try and walk you through the most important things. this is my execution chart, so it kind of gets cluttered up during the week, and then at the end of the week I delete it all. One of the reasons why I am expecting us to sell off down through these lows is not only the fact that there's a lot of liquidity down here, but also the fact that we balance the entirety of this buy side imbalance, sell side inefficiency. So this busy, when price is preparing for a low resistance liquidity run, so a very fast move in one direction, what it will do is it will come in and balance the entire range so that it doesn't have to paint backwards and forwards, let's say. And you can see right here that we traded all the way down to the completely fill in any imbalance in this area and then traded higher. All that's doing is it means that now if price wants to trade lower, like over here, if it had traded lower, it would have been very high resistance like that, making its way. But now it's got nothing in the way for it to run all the way down into this area down here. So rather than doing a very zigzagged approach, it should be able to just go quite aggressively. And I really liked that narrative. And last night I saw that. In fact, I'll even I'll bring up the chart, but it was on this one. So I was doing a top down and I started recognizing the market maker model framework. You can see I was writing out kind of the sequence of things that I saw happening throughout the week, with Friday selling off, engineering that high, taking it out, retesting it, and then the next day beginning to sell off. And at this point, we were right here on this candle, I believe. And I started recognizing, okay, well, this kind of looks like a market maker model. We have the original consolidation, we have the smart money reversal, we have a short-term high, intermediate term high, short-term high, breaks the low. And now it's expecting, since we've now broken this low, has been broken, I'm expecting us to have second stage, which typically will be a very shallow retracement and then just dump. So I was actually expecting us to remain fairly heavy right here. We didn't end up heavy, but we have not taken out that intermediate term high, which I'm expecting to stay intact. This is something that I saw play out a few times last week, and I actually caught a few good trades using it. It's when you have a market maker model framework, but rather than second stage being just a very shallow retracement and then dumping, it ends up being a very extended retracement. However, it still ends up playing out. So what I'm kind of expecting here is for this to be second stage of the market maker model, with first stage being here, second stage here. However, I'm expecting it to be like a very deep retracement and then make our first stage and then second stage of second stage being a really nice move. So I'm still thinking that that could play out. I know this isn't very clear to tell on the 4-hour time frame, but if we drop down to a 1-hour time frame, you can see it a little bit better. You get that smart money reversal. A little bit tricky in here. I'd call this a low risk sell. And then I'd call this the intermediate term high. I'm saying I'd call it because, as you can see, it is very consolidatory, if that's a word. I think it is, within this range. But then eventually breaking this low, running back up into these highs, you can see a nice intermediate term low put in here, then making this run up. Now, I really liked this high that we put in last night, so I'm going to jump back over to the other chart. But I really liked that high because if you look at this 4-hour chart on the right and then the 1-hour, you can see that we actually whipped up above that 4-hour candle and obviously took out the high of day, which is that Asia high I have marked out. I have it marked out because that is a very obvious buy side pull that we've clearly just attacked. And if we jump back over to this chart, you also see I have these lines marked out on these highs, just indicating that we had been accumulating the buy side pulls at a premium above the new week opening gap. And that brings me back to the 4-hour chart and this markup I was doing and writing all these notes, as I was recognizing how the weekly range was playing out. We had opened the weekly range, engineered a high at a premium above the weekly open. So the weekly open acts as essentially a fair value for the week, and you want to sell above that, buy below essentially. But if we're looking to be bearish, we want to see accumulation happen above that weekly open. So when we engineer a high and then sell off below the open, you know that we've engineered a premium high. We're enticing people to sell at a discount before running out to take out that buy side at a premium above the open. Then every time you see an obvious high that gets rated in all these different places, you can assume that that is accumulation of premium buy side. And we had the exact same thing happening here on Friday. We're running up, taking out all this buy sides above the weekly open. And that really setting the stage for, like, I reckon Monday could easily just dump quite easily. But jumping back over to this chart, as we had 11 a.m. close right on its highs, instantly reversed after ticking above the high of the 12 p.m. candle. And also the fact that 12, which is lunch, reversed is another factor that could indicate this is a longer term high. A lot of the time when we are having a high time frame reversal or just a more extended high that's going to stay in the market a bit longer, it will reverse right at 12. During the lunch hour, I don't know exactly why. I just imagine that the traders are on their lunch break and they're not paying attention to the chart, and so they're going to miss the nice move, and that's the only reasoning I can think of for it. So this next 4-hour candle, you can see it is running lower really nicely after having run back above that Asia high, and that's what I was watching this morning and why I took that trade on the TopStep account, the practice account. Also took it on my personal, but personal I'll walk through exactly where I got in and why I got out. So you can see some nice smooth lows down here as well, so being left behind. So there's nowhere for trailed stops on this 15-minute time frame. Then if we drop to the 5 minutes, once again, when we have a really impulsive move like this, I always scan through the move and look for the swing lows, because if we are to pull back, we're likely to attack a swing low. On the 5-minute time frame, the only swing low is all the way down here. And that is a really nice thing if you're looking to take a short. It means that if we were to go short, that would be a very, very high probability target. If we drop down one more time frame, so I'll make this the 1 minute now. Now at this point, you can see there was a swing low right down here, and we actually taps that really nicely. This is the current new day opening gap as well. This is Friday's daily open. That's all it is, but it's not super important. So tapping into that impulse low, getting that reaction. A lot of the time you will see reactions like that from a impulsive low before a big move. But I was expecting that to fail for the reasons I just mentioned. And I recognize that, okay, now we have 1 p.m. high. So this is an hourly candle high. We open up 2 p.m. and then just start trading high instantly. So at a premium above a candle, it's open. So above a candle's opening price is a premium, below is a discount. Very similar to that new week opening gap, that weekly open being a premium above, discount below. See that 1 p.m. opens up, engineers a high, and then drops straight down below the open. So at the moment, 1 p.m. is consolidating at a discount to its opening price with a premium high above it. What that's doing is anyone who's chasing this short, they're going to be putting a buy stop above this open, which is at a premium to the 1 p.m. opening price. But also if we look at this range, you can see it's the wrong one, but from this high down to the low, you can see that it's actually at a premium of the range as well. So this right here is at a premium, and then above that we have this swing high as well. But I was noticing how we're running up to premium above the 2 p.m. open and up towards the Asia high, and I wanted to get short. I recognize that, okay, I don't want to get squeezed out. So how would I get involved? Now there's a entry technique that I have, or a concept, where post halfway through an hourly candle, if we start showing bearish order flow, then it means the high of that candle should be in place if you're expecting a bearish PO3. So if I'm expecting the 2 p.m. candle to run up, run higher, make a high, and then close lower, or at least turn around, then if we start showing bearish order flow and it's past 2:30 p.m., then that high should now hold in place. That's essentially what is looking to happen right here. I'll bring that up on this chart now so that we can compare this to the 5-minute time frame. So right here, this candle is at 2:31 p.m. and I was looking at the 5-minute. I could see that we'd engineered a long wick on this 5-minute candle. The very next candle runs up, takes out that long wick, and rejects lower. The key thing for this area is pairing up the narrative on multiple time frames. So the narrative on the 5 minutes was that we'd engineered a long wick. We'd then run that long wick out. So anyone who saw that long wick, they went short, they'd get taken out on this candle. If you pair that with the low time frame, how did we take out that long wick? Well, we had a really large range up closing candle that took out another long wick on the 1-minute chart and then instantly reversed. When you see large up closing ranges like this, I see that kind of as a enticing move. And so if we were to break back down, a lot of the time those will hold as very nice, I suppose, order blocks. We have a really obvious impulse low down here as well. So we're just enticed longs with this large up closing range. We have a really obvious impulse low. We fell short of it right here and then run back up into the range. Now, usually I'd like to see a fair bit of displacement right after we make a move. I don't want to see us just hover around for ages. So I wasn't super confident in this area. I did go short based purely on that post halfway through the hourly candle. So that's 2:30 right there. We were after 2:30. If that's 2:30, we're after 2:30. We are showing bearish order flow. And I can say that because this wick, you would have wanted to see that hold price eventually and get back above it quite easily. And also, I need a 15-second to explain this. Because when I'm trading, a lot of the time I'll have these 3 charts up and I'll have usually the 15-minute up in this corner, the 1-minute. And then when I want just a bit more information, I just look down at the 15 seconds. So yeah, what I liked about this is, one, we had that large uprange 1-minute candle. It is after 2:30. We also had a 5-minute wick that gets raided out, breaks back down. I was watching this swing high. There's a swing high here that we didn't hit, but there is also a swing high on the 15/5 second here. I was watching that. I recognized that, okay, if we are bearish, I want to see us reject from this area. We started showing rejection. That was looking really good, but at this point, it was still kind of 50-50 because we did still have a few smooth highs. And I kind of felt like, well, maybe we just dropped it down into this internal range to make one more run higher. And it was only really because we had that 1-minute large range candle combined with the long 5-minute wick that got taken out, it gave me the confidence that this probably was the reversal. But it wasn't enough confidence because I didn't hold the trade how I wanted to. I just held it for literally like a few points, changed my mind, got back in here, held it down to these lows. And then I figured, okay, well, if this is going to be a nice move, sure, we took out a 5-minute candle high here, but I'd like to see us take out one more 5-minute candle high. And what I identified was this large down closing 5-minute candle. It's like, that's great. If we run up and we take out this candle's high, even by 1 tick, then I will get in. I'll get in short above that high. So I set a sell limit at that candle's high. I actually got tripped in, but then I saw, wait a second, the high of this candle is actually 3 points higher. So this comes in at 89.46. This candle's high is 89.43. And so I actually closed out the position right here. And I'll actually show that real quick. But yeah, it's kind of a bit disappointing. I made $5 as you can see, so really cool. But yeah, taking that initial trades that I wasn't super confident about, barely holding it for any of a scalp at all. Putting a sell limit at that candle's high, it gets tripped in. I then look at it and I'm like, oh, it didn't actually take it out yet. So I'll close out the trade because I only want to get in above that high. And it results in this. So a little bit frustrating, but at least I caught it on my paper account. If I can find it. Gold. There we go. But yeah, so not too sure what I could have done differently right here. Maybe using, rather than trying to get short here and being sketched out and using mental equity, second guessing myself up in this area. Just need to change that. But rather than doing that, waiting for that clear displacement lower, such as we get right here, that was from a very key point of interest that fit all the narrative I'm thinking of. Also a new 4-hour candle open. And then after that happens, just trusting that, okay, this high will now stay intact, and just trusting that analysis to play out. Like, as you can see, it really did look like it could easily tap above that high. I've seen that play out a lot of times where you'll have a 5-minute candle high such as that. Price will run up, tap it out, and then get that nice move low. But I suppose we did take out a 5-minute candle high. If we drag down to this 1445 candle, we engineer that obvious high, pulls back a little bit, works it out, and then dumps lower. But very much a consolidation type of scenario right here. And yeah, just not super obvious. There is one way I could have got in following this, and that is using my second stage IRF framework. And I'll quickly depict that using this. So we've got a reversal, a low risk sell, we've got a first stage of the model, and then a second stage, and then you're looking for this entry right here. And how I mark that out is essentially finding a reversal, looking for that first main pullback that puts in first stage, and I usually just put a dashed line there on that low. Then below that, I look for the next swing low, and this becomes the way that I get involved. I'm looking for that retracement after first stage is already played out, for it to break that retracement candle's low, trade back above it, get a closure above, closure back below, and then the entry is essentially like that. Or wherever that trades to is wherever you'd put your stop. That did actually play out here. And this is one of two frameworks that I'm thinking I know really well. I can recognize them pretty good. And I can actually also see ways that I could trade them consistently by executing it the exact same every time. And if we look at this area right here, I can see it quite easily. We've got a short-term high, so we've got the reversal. We've got a low risk sell. We then break this low, get that shift, have a short-term high, intermediate term high, and then break the low. So that is first stage has played out. Now, after first stage being played out, we're looking for that swing low. We get it. We're then looking for a run back above. So we break that low. We trade low. Now we need buy side delivery and a closure above, which we get right there. So we deliver buy side, we get a closure back above that low. We then break down, get a closure right back below that low. That is the entry signal. However, the entry in a case like this, so I'll do a M1 IRF, impulse rejection failure. Sorry, second stage. That's the framework / entry technique name. But once we got that, because we closed so far below this blue line, what I then do is I measure the midpoint between the closure and the line, and the entry is now at exactly the midpoint. So my entry would have been precisely there. My stop loss would have been exactly there. And how I would have traded this if I had been trading using the exit criteria that I'm still developing. And this is the number one thing I need to focus on right now. Like, I've got all of the best models in the world and all the best frameworks and understanding of prices. Like, it's more than I need. Like, I could be catching ridiculous moves if I was trading correctly, but then as you can see, I'll catch the absolute high, the perfect entry, and hold it for a $1 move, which is just pathetic and embarrassing. So how I would have traded this using my standard operating procedure that I'm developing and I'm going to start implementing next week, 100%, you have my word on it, is once I get this entry, I'm waiting for 2 breaks to the low. So we get that first retracement and then break of the low. This becomes number 1. So I'm going to type out 1. We're then looking for another low to be formed, which gets formed right here, a swing low. This becomes number 2. And it's only at this point right here that I start managing the trade and going to break even. And as you can see by here, like, it's not coming back to break even. A lot of the time, even if number 2 was up here, you'd be able to go to break even at this point, and then price would never return back to your entry. It would just keep on selling off. But if I just had standard operating procedures for taking profits, such as another one could have been that, okay, once I have, if my framework's based on a certain scenario, such as the fact that we have a potential long squeeze in this area with no 5-minute swing lows, we've already hit a 1-minute impulse low, rejected it, and now we're failing and coming straight back down. So the next level I'd be looking for should be that 5-minute time frame swing low, which is all the way down here. So maybe that would be the standard operating procedure, would be to reach down to that. But like, if I can put in a very robust, concrete way that I exit trades, I'd be able to trade way more effectively. Like, imagine if I caught just a casual 15R, or if I had closed the entire trade down the second break of the low, 10R, or if I had simply taken this trade with a stop loss at the high, trusting that that high was now in place, and not have just closed the trade after 1 point and just held down to, yeah, just to that 5-minute swing low or wherever. Like, I'd be able to do pretty well, be able to do a lot better than I did. And like, this is a demonstration of how it could look. This wasn't even the entry that I wanted. Like, I had my limit sitting up here on my TopStep account as well. So if we jump over to my TopStep account, which is daily loss limit, but I had a limit sell in that exact same spot above that 5-minute swing high, and I was waiting for that to get hit. And it never did. I just put on the trade on this paper account to make sure I was getting the sizing right. I was like, cool, just put on how many contracts should I put on so that I'm risking the amount that I want to risk. And then I just forgot about it. Came back, it's like, oh, cool, it went my way. But yeah, there were, I'll see if I can remember where this also occurred. Oh, that's right. Literally on Nasdaq, this exact same framework happened as well. So I'm going to copy this, not that, Control C, jump over to Nasdaq real quick, and we're going to identify where it is here. Now, we did fall short of this 15-minute high, and that had me initially thinking bullish, but as you can see throughout this entire day, and we sold off at the open, But since around 11 a.m., we've just been rallying non-stop with a small pullback here, but otherwise really obvious impulse low, and it just rips straight up. So that's you. In this scenario, you know that there's going to be people looking to trail their stops. Anyone who trailed their stops here, they need somewhere else to trail it, especially after such a big move. And there's a very obvious area right here. So when I bought down here, I closed the position straight away, recognizing that, okay, this is not looking so bullish anymore. We then broke this low, but we failed to reject up with any conviction. You can see I've got a nice blue line marked out here. And what that is the exact same framework that I was talking about, where we've got a reversal. We then have a pullback that makes a high and then break that low, engineer another low, have a pullback, break that low. And at this point, if this was bullish and we get back above this low, I'd want to see it continue pushing higher. However, I was expecting we were likely to reach a bit lower because we got this really obvious impulse slow down here. And not only that, but also ES had the exact same thing, and ES was sitting very close to that low. It looks like it definitely wanted it. And I wanted to see at least Nasdaq or ES hit that low before looking for any longs. As I recognized that we had this pullback after making that reversal, breaks that low, creates another pullback, breaks that low, I then recognized this framework. And I figured that, okay, well, I can now look for this exact same framework to play out, which means that once we break this low, I want to see a closure back above. We get that right there. That candle closes above that swing low. I then want a closure back below that swing low. And we got that on the very next candle. It's like, cool, that's it. I'm jumping in short. Stop loss goes at the failure swing high and looking for that run down to this level at least, or if ES hit it as well. And as you can see, it came really close to that stop loss, didn't quite hit it, and then sold off really nicely. And that could have been a beautiful trade. But I switched up my mind in here. Then I tried once again getting short, put my stop loss super close because I obviously wasn't confident in it. And then it sells off. I did jump in short after I saw this initial displacement. I saw, okay, this should now remain open. I'm going to get short at 450 even. Caught a little scalp down into the range, but nothing significant. And once again, I need an exit criteria. So using that same methodology I mentioned before, we've got the first break of the low, second break of the low, then manage the trade. If we were to have done that on the Nasdaq trade, let's say I actually didn't get shaken out of this, we have our first break, and I'm very aware that these charts are really messy, so I'll try and clean it up a little bit. So some of these things are important, but we got the first break of the low right there, and then we create another swing low. We then get that second break of that low, and then at that point you'd be wanting to make sure that you're definitely at break even and managing that stop. That could have been a very nice trade, and at a minimum should have been looking for this swing low to get hit. And I can say that confidently because what this line is right here, that's the difference between this sell side pull and the next closest sell side pull. An observation I made is that a lot of the time price will reject from that midpoint. So if we were bullish, price might wick into this midpoint and then run high from there. However, if we get a closure, such as we do on this very 1 minute candle, below that midpoint, that's an indication that we are going to continue down to the next liquidity pool. And a way you can use that is, let's say you were watching price against that closure below, and then it pulls back. You can then trust taking a short, trusting that it should make a new low and head to the next pull. And we actually had that happen right at the close on gold. You'll see I've got that same line marked out from this liquidity pool to this one here. So we just rated this liquidity and we reach up, we hit the midpoint of that. I was wanting to see, do we close above it or not? We did not close above the midpoint, and then that resulted in us rejecting back lower. If we had closed above that midpoint, I would have then expected us to maybe hopefully pull back a little bit and then run up to this higher pull. So that's essentially what that concept is. You don't want to be using it against the trend, ideally. If you're looking for a reversal, that is. Now, I might just wondering what else I should go over. So Nasdaq's interesting at the moment. I am thinking that we could get a nice long here on Monday, potentially from a down around the 180 kind of level. I'm just looking at the facts that we fell short of this really obvious buy side pull, and now we're pulling back into the range. This to me, it looks like reaccumulation, which means that any previous area of accumulation should hold for us to reaccumulate. Now, I'm not convinced about this area right here. Like, sure, we sold off into the range and then rallied, and you could see this as a bit of an order block, but it's not convincing at all, and partly because if we measure from this low up to the high, I'm just going to change that to 50%. You'll see that that's actually at a premium of the range. So this is a premium buy support, sell support that at this point will then entice higher. So now that is now discount sell side. This is our previous area of accumulation because we were accumulating a long position as we sold off down through this range, took out this impulse low. Once again, you can see that impulse low getting a really nice rejection back up. So this becomes our previous area of accumulation. And you'd say from that opening price and that down closing range to the low, anywhere in this area, and ideally in the upper half of it, so above 24,050, I'd be looking for potential long in this area. And that's because that's simply based on the fact that we fell short of a really obvious buy side pull or the draw on liquidity. Like, I don't think we came up here to make perfect equal highs and then make a new low. I believe we came up here to head into these high inefficiencies, and the fact that we failed to do so indicates that we're going to make another run up higher, and that's reaccumulation. I believe ICT is mentioned in a video once that it's the highest probability, easiest trade you can never do, and that's when we fall short of the draw, pull back in the range. So put my hand right in front of the camera. But yeah, pull back into the range to a previous area of accumulation before ripping higher from there. Reminds me of some epic price action back here, and I might as well walk through this. As I mentioned, this is not a structured video at all. This is just me talking through anything I want to. This is FOMC from Wednesday this week. Now, I was on site for FOMC. I was bullish, and I caught the low, caught a nice run up. Tried to buy again in here, but I messed it up and ended up not being able to get in. But what I was seeing is essentially how it all starts off down here. We have a really nice bull flag. Now, a lot of the time with bull flags, I want to see them fail. I recognize that a lot of traders will see a bull flag. They're expecting price to then break out high like that. When it fails to do so, I expect price to become really heavy and attack this low. So we've got a significant sell side down here because anyone who is buying up in this range, that's the only place for their stop loss, below this impulse low. Below that, you'll also notice how we have this untapped order block. So the lowest opening price that makes a low, that takes out sell side and rallies, that becomes our order block. You see we dropped into that really nicely, raiding out this sell side pull. And at this point, during the overnight, I was actually bearish, and I wanted to see if it wanted to continue pushing lower. I've got a framework called the Pinata model, the Pinata framework, which is essentially when you have a bull flag that fails, and then I'm looking for that lower range to hold price and push it lower. And the idea is the narrative of traps longs, and we're not going to rally back up and let those longs out their position before we take out their stops. However, in this particular case, we did take out significant sell side, but then we also rallied and took out this high. That invalidated any bearishness for me, because with this particular framework, if we were bearish, we should have remained very heavy. So at this point, I was like, okay, this is looking kind of bullish. Is there anything that would support that? Well, this is a previous area of accumulation, and that's because in this area, we dropped into the sell side pool down below here, and we accumulated. That becomes a order block, essentially. And with that previous area of accumulation, we then have these multiple equal lows, including a impulse low with this 9:30 a.m. candle that was engineered just above that previous area of accumulation. And so that becomes a very significant sell side pull above another order block, an area of accumulation. We had already sold off and hit that before I got to the charts, where it's got this nice reaction back out, left a long wick on the 1 hour chart. However, because of the narrative of clear sell side that was accumulated, and then more clear sell side that gets accumulated here as well, I trusted that, okay, we're clearly accumulating. We have this really sharp drop down here that sure took out all these highs, but you'll notice this comes back to that low resistance run that I was talking about on gold, where we have the entirety of this range is now balanced with this run up. Any inefficiencies that were, let's say, between this sell-off and that high, so you'll find the low time frame to be, because we took out buy side here and then broke low, some form of a inefficiency in here potentially. We've already balanced all of that and then sold off, which is preparing the range for a low resistance run into those highs. Now, the next thing that stood out, and I was doing a markup of this, I believe, as well, but we have a clear market maker model framework here, and we can recognize second stage of the market maker model. Now, if you remember from market maker model, we've got the smart money reversal, first stage, which consists of a short-term low, a intermediate term low, and then a short-term low to the right of that. Then once we break that high, at this point right here, first stage of the market maker model has officially played out. So you're going to do first stage, and after first stage, what happens? Well, you're looking for a second stage of that market maker model. This is also similar to gold in the sense that second stage doesn't just pull back very shallow and then rally, which a lot of the time, if we were super bullish, you'd expect second stage to pull back like that and then just rip from there. That doesn't happen. We pull back really, really deep into the range. In fact, all the way to a deep discount of this internal range. But this is still second stage of the model. Now, within second stage, we have a fractal market maker buyer model as well, with a consolidation, first stage, second stage, first stage, second stage. And now you can start recognizing if this is the smart money reversal, then this is a short-term low, this is a intermediate term low. We then break this high. So this break here is the exact same thing as this high time frame break, however on a fractal level. So after this, we're looking for second stage. After this, we're looking for second stage, and that's what we get right here. This second stage just happened to align exactly with the NVIDIA earnings as well, which is the volatility injection, that news driver that gave us this beautiful run higher. I was able to buy right down at this low, really nice trade actually. And how I did that was essentially just finding the impulse low, drawing that out, I note that as a old low. Whenever there's a significant liquidity pool, such as this, and on gold we had that Asia high as well. So when we have a significant pool like that, I like to see us refer back to that level, and we either hit it or don't hit it. In this case, we actually go a few ticks below, but I recognize that I was able to buy right down there, capture this run higher. Another thing that gave me confidence in this trade was also, if I get rid of this line, we have this 12 o'clock candle, so 15-minute impulse high that sells off. We then consolidate ahead of the FOMC news. So everyone who wants to get positioned ahead of the news, where are they going to put their stop loss? Well, they're going to put it at their next swing high. We never took that out throughout the entire consolidation, all the way up until 245. We never took out that high. We also had a manipulation closure, which is a closure above the midpoint of this wick. You can see that here, midpoint of the wick, we close above it. And then that results in a instant reversal back down. Now, when we have the signature, that represents a original consolidation. So on another fractal, this starts another market maker buy model fractally for first stage. So this is beginning to get very detailed and specific, but it's just some of the stuff that's like I see in price, and like it gets me pumped up because I can see it there, and I executed on it as well. Like I literally bought down here. I was going to buy here, so I had a limit order sitting at exactly this low for second stage. It wicks down extremely fast, and on my CFD broker, it did not fill me, which was kind of annoying. I then figured, okay, well, if this is it, this is just rip from here. This is looking really good. So I bought up here. It takes me out, and then I tried once more. I get taken out, and at this point, I'm like, I'm done for the day. Like I've just lost, half of my day's gains, so I'm not going to touch it anymore. But yeah, it ends up ripping anyway. It just wanted to come down for that one more sweep, which ahead of a news driver such as Nvidia earnings, like price can come for another sweep. I think I just need to have been less specific. But how I could have traded this was, one, yes, buying below this low is exactly what I should have done. And then two, how I use this range is because this is second stage of the consolidation, first stage, second stage, reversal, short-term low, intermediate term low, short-term low. It breaks this high. And then after breaking that high, we're looking for that pullback. And you'll see how I'm using that exact same line. And that's because this is that exact same model that I was talking about before, where we have the second stage IRF entry. We have the reversal, a high low, breaks the high, makes another pullback, breaks that high. We're then looking for a closure below that line. We get that right there. Closure back above, get that right there. This would theoretically also be a trade that would be valid. Sure, it might be a little bit scary to take, but I mean, it works. I just say it's scary to take because we just have this big blast off move, and then it has this pullback. But that theoretically would work, and actually the entry would be here because it'd be the midpoint between that candle's close and the line, and that could have been another really sick trade. This could have also been a sick trade, and back to where what's we about before. My stop loss could have been down here, and that's based on this consolidation. So as I mentioned before, on the 15-minute chart, you can see that we've got the midpoint of that wick and the closure above the midpoint that indicates a original consolidation. On the lower time frame, you can also identify this as a consolidation by the fact that we have this run higher from this low up to that high. That's our dealing range. So that's our dealing range. We then paint lower, paint higher, but consolidate within that range before breaking it right here. So at this point now, this range is balanced. Midpoint should act like a brick wall. It does not act like a brick wall. We get above it. So that's now indicating bullishness, which is why this was a good buy right there. as well if you want us to get in the move. But also, after getting above it, we should no longer drop below the midpoint of this range. So by putting a stop loss below, or let's say in the lower quadrant of that range, that's where I do it, that should be very safe. And that would have worked out beautifully as well. This is very similar to, and I'll bring it up real quick over here I'll go to the 5-minute time frame. It's a wee while back, a few weeks ago actually. I think all the way back here. But we have the exact same scenario happening here where we have, I'll just see if I can walk through it. Pullback, we've got a smart money reversal, low risk buy, a short-term low, an intermediate term low, and then breaks the high. And at this point, we have now played out first stage. So this being broken out is essentially, I'll do that one right there. That's first stage being played out because we have the reversal, low risk buy, short-term low, intermediate term low, breaks the high, pulls back. Now this is where we're looking for that same second stage as over here. That's the same as this stage here. You can start seeing it looks very, very similar. I'll zoom in a bit. See you got this one reversal, short-term low, intermediate, short-term low, and then breaks the high, pulls back, and then has second stage. And second stage, you can also draw out that exact same line like that. However, what I recognized here is that we had a consolidation. So from this high down to this low, draw that across. That is a consolidated range. We then close back above the midpoint, indicating it's not so bearish after all. We rally above it at the 1800 open, actually at the Sunday open. But now we have played out first stage right there. We're now looking for second stage, and this is second stage within second stage of the model. And so this is why this becomes a very, very key entry and a really high probability trade, which I also caught, and I ran that up. In fact, I believe it was on just the paper trading account. I think I did execution as well. So if I do show executions, there we go. But yeah, the exact same thing. Let's say second stage, expecting that to say partially unfilled. And then once we started running higher, that could have actually been entry there, although I wouldn't have actually taken it because we did not deliver sell sides below that low. It should, if it had broken a low and got a 1-minute closure below that that line, then on a closure back above, that would have been the same thing as this right here. But you can see how this being second stage, also aligning with that 4:20 p.m. NVIDIA earnings, that volatility coming in at exactly the right time, and the fractal nature of this being reversal, and then, yes, spiral reversal, first stage playing out, second stage with a very deep retracement, but it's still second stage, that results in this beautiful run high. And that's kind of what I'm expecting to happen on gold this next week. Turn those off for now. And this is really ugly, I know. I'm going to hide some of that. But jumping back onto the 1-hour time frame, as I mentioned, I can see a market maker model right here. I can see a consolidation, reversal, a short-term high, intermediate term high, short-term high, breaks the low. And so what I'm seeing is that this is now that low being broken. As I mentioned earlier, I'll get rid of that previous day low. But if that's that low being broken, I'm then looking for a pullback and for us to break this low. Now the pullback is a lot steeper than I had anticipated. Like I actually sold right there, had my stop loss above the swing high, and it pulled all the way back. It did not take me out, and then I got out for a small win down here, recognizing that it looked like it wanted this high now. But if we're then having this really deep pullback, but if we can recognize that fractal market maker sell model, and this is in fact second stage of the high time frame framework, trusting that this high is in place because it did get a candle closure above the midpoint of the range. Then what we can look for in this range is for on Monday for us to put in a short-term high, intermediate, and then a second stage right here. And then that second stage is aligning with the second stage of this higher time frame model, which is how you can get those really extended moves, which would run out all this low resistance liquidity down here. That's my kind of thinking. I can't prove that's going to work. I don't know for sure, but you know, it's worth looking into, and I'm going to be watching it on the Sunday Open for sure. The only things that look a little bit dodgy is just the fact that this is a consolidation, and in a consolidation, we could just run back up into these highs, and we do have a consolidation up here, relative equal highs as well. You see I've got some stuff marked out in these charts. A lot of these areas, like I was short here, but I got taken out by a few ticks and then it sold off. And these are just some of the things I need to go over and get a better understanding of what I'm doing, because like this is another example. This is today even. This was today during the Asia session. I recognized that we had, in fact, the exact same framework. I was looking for a market maker sell model for second stage to play out. I really liked the fact that this is the 2 p.m. low, so an hourly candle low. We had not yet hit that. We had this really obvious impulse low that runs higher. I was actually trying to sell in this range with a stop loss at the high. So I was literally selling here, expecting this high not to get taken out. It does get taken out. And so I get stopped out. I took a big loss. And that's one of the things that actually ended up finishing my account off today. One of my small personal account that I funded a few weeks ago. It just took its, like I had it was nicely in the profit at the start of the day, and then after a couple of losses, it's just got completely wiped out. But this trade was based on the fact that we had trapped longs from these lows. We'd rallied high. I was bearish. We had started pulling back. We had not taken out the swing low yet, and I was expecting my sell the dip framework to play out, which is where I want to see buy side delivery. After that buy side delivery, I'm looking for us to break the low and then go short. We had actually already taken out the swing low right at the 1800 open, and that could have been a warning sign, but I saw this as being a consolidation that should hold, and that we would just continue just melting over lower. So when we ran up into these highs, after having fallen short of a 1 minute swing low down here, I figured that this was it actually sounds silly talking about it now, because I have a name for everything and it's clearly not working. But this was the intermediate term low market structure shift to deep internal range, which can often result in us breaking our intermediate term low that indicates bearish price action, but then reversing back into the range. Lots of the time that will come to a deep premium and then reverse. So I sold right there at that swing high, recognizing that, okay, well, this high should stay intact. So my stop loss at that high, I sold right there at a deep premium of the range. However, I decided just to work that out and then sell off, which is all good. It then dumps into the range without me, but then I really was happy because it fell short of a 1 hour swing low. Also, 1 hour low also fell short of the 5 minute swing low, and then pulls back into the range. And I was like, okay, well, if this is the smart money reversal, I could then identify first stage being this area right here, and then it breaks low. So I want to see second stage of the market maker model play out. And when we were running high, I was like, okay, well, if it's going to play out, where is it going to play out from? Well, we want a swing high to get taken out. And this is a hourly candle open. I'm going to drop to the 1 minute time frame and run back over that same area. So on the 1 minute time frame, we have that 2000 candle opens up, just sells off, consolidates at a deep discount, then rallies into the range. Now, as it's running up, I'm thinking, okay, well, anyone who sold in this area down here, their stops are going to be above this swing high. I believe this is first stage, so a previous area of accumulation, and that should hold, this intermediate term high should hold price if we are bearish and we're going to take out this hourly candle low that we clearly failed to take out down here. So I went short at that swing high. I put my stop loss above the intermediate term high, exactly how I should have. And then it gets this drop in my favor. I'm like, sick, I'm going to be a millionaire. This is great. I'm a really good trader. I'm the best there is. And then it rallies back up. And I'm thinking, okay, well, that's fine. You know, it can come up once more. There's nothing wrong with that. But it starts pumping up and accelerating into these highs. And as it's accelerating, that makes me start second guessing. And I'm like, okay, yeah, there's no way it's not coming for these highs. So much speed into there. We have kind of smooth highs up here. Maybe I was just wrong about the whole thing after all. Like I was wrong over here. Like I tried going short there with a stop above this high, and that was clearly wrong because it got taken out. And now the same thing's going to happen here. It's going to rally up, it's going to take me out, and I'm going to be screwed. So I just closed the trade like right there, basically. Probably when we got this wick lower. It's like, cool, it just gave me back like a few points. I'm just going to jump out there just for a small loss. And what do you know? Well, it falls just short of that high. It does not take it out, and then it just dumps. So yeah, a little bit frustrating. Like it's honestly so frustrating. It really is. Like I couldn't tell you how many moves I can see happening. I should be part of. Some of them I even have a plan on how to be part of it. But I'm just being so inconsistent with my executions. It's actually unreal. And that's why I was mentioning earlier, like the number one thing I need to do right now is to make a standard operating procedure, a exit protocol that on very, very specific trades, I always exit the exact same way. Even if it doesn't work out exactly how I would have wanted, I know that the next time I trade it, it'll work out 10 times what I wanted because, yeah, because I've optimized it. But the exact same thing over here. Obviously, this is the previous day low, I think, or somewhere is. And I was expecting that we would sell off. We'd hit that previous day low. However, in this area, you can see that one, we'd just sold off. We'd remained at a discount below this high down to the low. We never returned to a premium. We're just consolidating down here. This is the 2200 open as well. So this high right here, that is now a 4-hour candle high. A very significant pull of sell side, of buy side liquidity, sorry. We then sell off, start consolidating in this range. And what I noticed in this area was how we were just consolidating in here. And anyone who's going short here, where are their stops going to go? Well, right above there, very obvious high, and that's engineered just below that 4-hour candle high. That's another thing I've noticed before is that when we have a pull that's going to act as a very, very key pull, lots of time we'll engineer a pull just a bit below that as kind of like a decoy. So anyone who's, let's say, wanting to put their stop loss there, but then think, oh, you know what, screw it, I'm going to move it and be a little bit more safe and put it to the next level, then they get taken out. But plenty of time consolidating below this obvious high for buy side stops to accumulate up there, then it sells off. What I really liked about this was the fact we had this really obvious low. We had midnight open up, consolidate above the midnight open, so at a premium to the market, a midnight open price, and above a really obvious low. This becomes a bull flag formation for one, so we know that there's going to be significant sell side below that low. And so when we sold off down below this low, what I wanted to see was us fail to reach that previous day low, which is this, fail to reach the previous day low, and then run up into the range, take out that 4-hour candle high, and then I wanted to get short from there. I walked away from the charts. I came back and we had just had this massive work up, big retracement, and then started trading higher. So I was like, oh, damn it, I missed that long. And because this was my target, I was like, okay, I want to see it hit this 4-hour candle high. It hadn't quite, and then it ran up and hit it. But I thought, well, you know what? Best case scenario, maybe it could actually reach up here. This is where I want to get short from. If we had continued to push higher, I would have been very, very interested in getting short from this level right here, because it's a premium impulse high right at this hourly candle open that made this high as well. So it's like a bearish order block. Want to see price hit up to there. We had already hit that 4-hour candle high. However, I figured that, you know what, it could make another high. It really could. We had this big up closing range, then a massive down close, and then rallied straight back up. So if it is going to take out this high again and potentially hit up to this high, then I could buy below this short-term low and put my stop loss just a bit below the midpoint of this range. So that's exactly what I did. I was like, you know what? In fact, this was the trade that finished off my account because it was almost gone. So okay, sweet. I'm gonna buy down here, gets me in, and then goes straight down to my stop. And as soon as it takes me out, then I'm like, oh, you know what? It's clearly bearish now, and now it can go lower. And I try putting on a short, and it's like, no, you don't have enough margin. So, but I got 2 margin calls last night for my 2 accounts. Um, one of them's healthy. Well, healthy, but you can see I've got a lot of stock positions on at the moment. So I'm in a bunch of solar stocks and shorting. I don't know what that company is, but I'm going short. Just for fun, really, which trading is fun. And yeah, so going for that long, definitely shouldn't have done that. Something I've noticed with gold is that if it hits an hourly or a 4-hour candle high or low, and it wants to reverse, let it reverse. It wants to reverse. Like even if it had gone 1 tick above this high, that would have, and it showed signs of reversal, I should be like, sweet, that's all it needs. Because many times you will find that there will be a hourly candle open or close, and it hits that candle, and you think, oh no, that was too shallow. It should go way further than that. But then it just reverses anyway, and it ends up being the high of week. And there's a perfect example of that actually. If we go to the 1 hour or the 4-hour on gold, in fact, it is the 4-hour. Yeah, I'll go to 4-hour. In fact, even better. There we go. There's the 4-hour. Yep. So up here, this is a very high time frame swing point. This is a major high and a major reversal. But if we zoom in all the way in here, we find that we had a 4-hour swing high. We then rally. We fall just a few points short of it. And the very next 4-hour candle at 2200, it rallies and goes, what, like, it goes like 1 point above that high and then reverses back down. Now, if you're watching price in here, you'd see, okay, we've got 2 equal highs on the 4-hour chart, and we just went just like 5 ticks above it and then reversed. Oh no, it's going to come back up and go a bit deeper. However, it doesn't. So just for future reference, you don't want to be shorting, or you don't want to be fading a move if it's taken a 4-hour candle high. And if we zoom into where I was trying to make another long, I think it was right there on the, if we zoom in more, I'm beginning to lose my, there. So it is this area right here. I'll go to a different time frame though. I'm getting disorientated myself. I can only imagine how anyone watching this video is feeling right now, seeing all this shit in my chart, getting disorientated. But yeah, you can see right here, we had taken out that 4-hour candle high. We had definitely taken it out. In fact, that's not a 4-hour candle high. There's the high of the current 4-hour candle high. But still, we'd taken out an hourly candle high. and then got that rejection low. And I should not have been going long like that. Even if I thought it could run a bit higher, make a new high, I should not be going long against that. Referring back to that same old high, the exact same concept as over here. We've got the Asia high, really obvious buy side pull that we clearly raided. We then drop below, come back up to it. Really obvious high, we clearly raided, drop below, come back up, refer to that exact same point, which is cool to see. And I feel like there's something else that's just about to go over, which would have been cool to talk about. Yeah, just don't go long against that. Now, I did try taking a short. I took a short, and luckily it worked out. And that's because I had my stop loss at ERL, so outside of the range. My stop loss is up there. But I actually was thinking, so if we jump back over here, I wanted to take this short. You can see this nice big line I got down here. I was thinking, cool, I think this is going to be second stage. I'm going to get short above this previous hourly candle high, stop loss above the swing high, and I should be able to target down to the 80s at least. So at least down to there. That was kind of the idea. We jump back over here, we can see how that played out. So that's the hourly candle high right there. And I wanted to get short. I already had a short on. In fact, I perfectly shorted the high. I didn't take any profit because I was looking for that big move, but had my stop loss actually at the high, which is the correct thing to do. And it kind of gave me a bit of an insight and something I actually wrote on my whiteboard, which is just as a hypothesis. What if I always take trades using a low time frame for the entry confirmation, but the high time frame for the invalidation of the trade? And that would just help me to get the timing better, but also I'd have the opportunity to change my mind. So if the situation deemed it a good idea to change my mind, which it might not, but that would just give me more time, more room to make logical decisions based on what the price action is telling me at the time. Like if the situation changes, if we're sitting in this range, I start recognizing, okay, well, it actually is beginning to show bullish order flow again. I can manage the trade and then get some different points. But it just help reduce stress sitting in the trades than if I was trying to, let's say, go short here with a stop loss there. But I don't know, just something I need to think about. But I actually held this trade, shorted from there, stop loss at the high. I held, and as we started to rally, I started really second guessing it. And the reason why is because this is actually the midpoint of this daily wick. So if we measure out this daily wick, find the midpoint and draw it across, you can see that red line. We just dropped into that. Not only had we done that, but you can also identify we had 1, 2, 3 drives into a high time frame level, being that daily midpoint of the wick, and then got this reaction. So that is literally bullish order flow 101. That is bullish reversal, 3 drives into a high time frame point of interest below a previous day low. Everything is very, very, very bullish, essentially. And I saw that, and as we started to rally, I was like, you know what? I've screwed this up. I'm absolutely screwed. That was so obvious. 3 drives into the low, and then a reversal from the previous day low into a high time frame point of interest. And now it's ripping aggressively towards a really obvious high. So I figured that I was absolutely screwed, but I wasn't going to make the same mistake I'd made over here, where I closed the trade like right there before it hit my stop, and then it didn't hit my stop, made perfect equal highs, and then sold off my direction. No way I was doing that twice in one day. So I kept my stop there. I didn't do anything. I went to bed. I set a alert down at the 4 a.m. open. It came down and hits the alert. I was like, you know what? That's epic. It didn't stop me out. It's gone my direction. However, we are dropping into major sell side down here. We're quite extended into these lows. Hitting major sell side, we have that 3 drive into the lows, and we just left perfect equal highs. So I was like, cool, now this is my time. I can close the trade for very small win, like 0.5 R. And I mean, that worked out. That was the right thing to do. And I mean, what would have the difference been if I had been like, oh no, I don't want to take a full stop. You know what? I'm just going to stop out right here, because if it's going to come to here, then it's going to come to this high. And if it's going to come there, it's 100% going to take out this high. And imagine if I'd taken a 0.8 R loss as opposed to this 0.5 R win, which I took. That would have been a 1.3 R difference, just because I'd wanted to save 0.2 R. So by saving, if I'd moved my stop down to here and I'd taken a 0.8 R loss, but then I'd missed out on a 1.3 on a 0.5 R gain, that is a 1.3, if I'm doing the maths, I don't know, a 1.3 R difference in equity, just from moving my stop loss to try and save 0.2 R. And that does not make sense at all. So that's another reason why it actually makes a lot more sense to have your stop loss at external range, especially on an asset like gold, which likes to have these ridiculously deep retracements. And a lot of the time we'll leave those perfect equal highs and then just reverse. Also, a lot of the time it will tap those lows or highs and reverse. But yeah, it's another insight. Something I just saw before that I thought I'd mention as a little bonus. Squeeze reversal. What that is when we fail to take out our previous candle's low or high and reverse from that level aggressively with displacement. We are 100% going up to this most obvious swing high. And you can see this is a 4-hour candle open on 1400 open. It reverses and then starts rallying high, goes straight to that high. I actually caught a trade on that using that framework just today or slash yesterday. I just can't remember where it is. There was a trade somewhere that had an hourly or a 4-hour squeeze reversal, and I was able to recognize it. I just couldn't tell you where it is. It might have been this. No, that's the 5-minute time frame. I don't know. Anyway, that's a cool concept, something worth looking into, I'd say, and something I'm still working to develop, but super effective if you're trying to find a large move, like up here, like the hourly candle fails to take out the previous hour and then aggressively moves the other way. We know it's coming to that swing low. I'll zoom into this area right here because this was a loss I took earlier in the week on Wednesday. Actually, the Thursday Asia session, but I'll go to the 1-minute time frame straight away. Go and find it. And you can see a very similar kind of concept already marked out. The box just represents the consolidation. So from the range low to the high, consolidated in that range, then broke below it. And this is why I took the loss, because I expected that, I don't know what this is, can delete it. I expected that because this range was now balanced, we should not close back above the midpoint of this range. And we do. And I got stopped out with my stop loss at this swing high, thinking that it would then come up and take out this high. But what I recognized was that we had a manipulation closure on the 5-minute chart, which is where the 5-minute time frame closed above the midpoint of this 5-minute wick and then reversed straight back down. So that indicates a original consolidation / the genesis of a price move. And what that should have resulted in is me looking for that second stage of the move. And you can see that does actually play out where we have an initial retracement, and I'll use the same type of lines, but we then break that low. A little bit unclear here, it keeps on working its way lower, but let's say you were to use this next swing low and draw that out. It breaks it, it closes back above, it closes back below, but then it runs back high again. So a little bit messy, but it still does get that nice move lower. But yeah, I'll just throw it off here because I expected that we shouldn't close above the midpoint of this range. However, maybe if I'd used a 5-minute chart and gone to that same area, you'll recognize that the 5-minute did not close above the midpoint of that range. And yeah, sold off nicely. But I got taken out there. Once again, catching the high of a move and well, not catching it at all. And that's the issue. And I think the reason why I messed that up is because I took a very similar trade somewhere that did take out the high or didn't. I'm not actually too sure. I feel like this video has been very transparent as to where my trading is actually at. And like, I'm sure anyone who watches this can see very, very clearly exactly what I'm doing wrong and can probably tell me, literally just change this one thing, change this, just make a standard operating procedure for your take profits and you will be a profitable trader. You'll be extremely profitable. Like you could probably tell me that. You could probably really clearly see exactly what I'm doing wrong. And I kind of subconsciously know exactly what I'm doing wrong, but as you can see, I'm also not doing it right. And if I jump over to, as I already mentioned, my embarrassing executions that I'm embarrassed about, you see the same thing. So taking that long, deciding, okay, this is actually not good anymore, closing for break even. So very nicely done. Then recognizing, cool, this is now a short. I can tell that this is my second stage RF. That's my entry signal right in that candle's closure. So I went short. And then I started second guessing because the long wick right here felt a bit dodgy. We were moving up into that long wick. And it's like, oh, you know what? I'm screwed. This is not it. Closed out the position. And then I got short again. So we suddenly dumped lower after getting really close to this high. Thought, okay, this high actually looks like it's in, which I was correct about. I saw that. I was like, okay, the high looks like it's in. 15-second looks good to go. I'll drop down to 15-second actually. Yeah, so we take out a short-term high, aggressively drop low into the range, drop below the 80s. I'm like, cool, this looks really good. I'm gonna get short. And someone actually came, I was selling some things on Facebook Marketplace. They showed up to my door right as I put on this trade. So I had my stop here and I just quickly ran out because I forgot they were coming. I was like, okay, yeah, it's clear. I just quickly run away. And as it's gone, it comes up, stops me out at 88.25, which is precisely there. So I get stopped out with my stop loss right there. Which, you know, why wouldn't I just put it up where it should be? Well, because I was still sketched out with this long wick and second guessing myself. Stop loss was there. I get stopped out right there on that candle. And then sells off. As I get back to the chart, I get back to the chart right here. And this was my TP. I had a partial take profit for one contract down here. And that knocked me in long. And so I just taken a full loss. I then was long as price was going my direction. And that was obviously not ideal. So I closed that trade. Only one contract, luckily. And then recognize, cool, this should now act as a breakaway gap. We should get this nice movement lower. ES still hasn't hit that point of interest. So this looks very much like a short. I just taken a loss and 2 losses in a row. And I wasn't feeling the best. And so I only put 4 contracts on. Closed them all out really, really fast because I kind of knew that I wasn't in the right headspace to be trading anyway. And yeah, that's that. And what happened right at the end was I was still bullish because of the fact we failed to reach that 15-minute candle high. However, this was approaching 1550 as well. I saw, cool, we've had this rally. We've retraced quite deep in the range. We've taken out this impulse low. This looks like it could easily have a nice rip back higher. We have these right vertical highs up here as well. So this looks primed to rip. And this was just an incorrect trade. Nothing wrong with this particularly, but it was the trade that hit my max loss for the day of 650. And yeah, got long and then tried adding to the trade, and then it just stopped me out in that candle there. Well, I hit my max loss on that candle there. And that's done for the day. So like I can explain every execution and why that happens, but I'm not doing it right. And the main thing is the taking profit side of things. That's what I'm not doing the most. If I'm in a winning trade, that should pay for all the losing trades I take really easily. But looking back at my stats on my forex account that I just blew, my personal small account, which is this one here, and you look at history, if you go through all of this, it's like my risk reward is literally on average probably 1.5 when I win, even though my trades usually go a very, very significant amount of distance, and my win rate is very low because I'm over trading like anything. And so I'm literally got, let's say I have a 50-50 win rate, which is probably, it is literally what it is actually. I've literally got 50-50 win rates because I looked at the stats, and um and I'm only taking 1 hour at a time when I win or something. Like it's just, it does not compute. The maths does not work. It doesn't math at all. And then I'm wondering why like I keep on being unprofitable. And looking at my equity curve for this account, it literally is just a bear trend. Like it's just a nice move, and then a bunch of little down ones, nice move, a sharp drop off, a nice move, and then it's just slowly making lower highs, lower lows like that. And it's essentially what my equity curve looks like on that account, and that is proof that I'm doing something wrong. So although on this account, at one point this week, I was up, I was at 52, 600 or so. Like if we go last month, you can see that, yeah, like the fact that there's a green profit factor at the moment, it almost feels like it's more luck than anything else. And that's not because I don't know how to trade, it's because I don't know how to execute, or I'm not executing consistently at all. I think the fact that this is a personal account as well, and that it's got into drawdown pretty fast, also played a factor because I was, really just I was being greedy with trying to just secure some profit rather than holding for the actual move. And you can see that exact same thing that played out today in my other account, where I was short up here and then took it off for a tiniest little scalp because I was second guessing it and it had gone my favor for a few little points, which is kind of ridiculous. And yeah, I really need to just develop a consistent way of taking profits so that it's done the exact same way every time, and just have a more robust system for a more mechanical system for trades, such as this short I took over here. Like I was looking for a short from here, targeting all the way down here with a stop loss above this swing high. Now, because I mechanically left my stop loss above the swing high, I was able to close out the trade for a small win. Also recognizing the fact that things had changed, it was now looking very bullish. And so I was able to close that out for a win rather than taking a loss up here. Whereas if I'd overmanaged the trade, not done mechanically, I would have maybe scaled into the trade. And so I would have literally, let's say I'd had my trade up there to start with, and then as it rallied against me, added into the trade, then tightened my stop so I wouldn't take a full stop out, and then taking a stop, and then reverse my direction, and some of that. But by being more mechanical on it, it just reduces the mental strain and the stress of it. And it gives you the opportunity to manage the trade with the information the market's telling you, because the market isn't looking at my trade and thinking, okay, well, where's Dominic's stop loss? Like, okay, what's Dominic thinking? Let's try and screw him over. No, the market's just going, okay, we're going to go up here. We're going to make these equal highs, and we're going to go really deep into the range to accumulate, then we'll go higher. So if I can give my trade the room it needs for me to be able to interpret what price is actually telling me, like the narrative that's being painted by price, then I can adjust and adapt to it as the trade develops. So I can sit through the trade and go, okay, I see what the market's doing. Okay, it's coming really close to that high. If it takes it out, there's no worries. If it doesn't, then it gives me more information. Well, now it's dropping down. We left these relative equal highs. It's dropping down into this area of accumulation where we had these 3 drives below the previous day low. This would be a beautiful place to get long. And now, and since I'm in this short position, that's also a great place for me to exit my short position and buy back at this discount. And then I can be more fluid and move with the information the market's telling me, rather than being like, oh no, I knew it, the market's going to screw me over again. Like it's it's kind of how I felt up here today, where I had my stop loss above this high. I closed it right there, and then I looked back at the price and it just sold off like that. Like, dude, my account could have recovered the entire drawdown I've had over the past few weeks in one trade, but I moved my stop loss to save myself a couple of dollars. Um, yeah, it's a fun game. It's a really fun game, gotta say. I think that will do for this review. Review slash just a rant and a bit of self-reflection, a bit of a journal entry, I guess it really is. But yeah, I've got a million epic concepts and understanding of price action that's way more than I need, and has the opportunity to do incredibly well with. Like, I could do really, really, really well with this, even if I just had a model like this and I didn't even know it was going down here. Let's say I had no idea it was going to go lower, but I was like, oh, that's my entry. Cool. Well, I'm just going to go short, and then my exit strategy is I'm going to wait for that second break of the low. Okay, it's one break. Okay, oh, it's a nice move. Really nice. Okay, it's still not doing anything yet. Okay, second break of the low. Okay, now I can start managing my stop, and already we're at 8R. If I just had the correct way of managing a trade, plus my understanding that I think we're going to go down from here down to like down here somewhere, I should be doing, pretty good. So I don't know. For Monday, I believe this is a change in state of delivery. If we look at the 1 hour time frame real quick, and then I'm going to finish up. But I believe that this is now a order block because it is a large range up closing candle, took out some significant buy side pulls at a premium of the range while we're expecting bearish price action. The hourly trend is now lower. The high time frame draw, I believe, is heading down to take out these lows once again before potentially reversing back up. And so this order block should now hold. So from this open up to the high, that is the place to be getting in, somewhere in that range. I mean, 80s is probably a good spot, a bit below that maybe. But I believe we've accumulated really nicely above this new week opening gap, and I don't see a reason why we need to take out this high again, unless you see this as being a high time frame consolidation kind of range, which we could do. We could just start ranging in this range. But yeah, that's my expectation on gold. Then on Nasdaq, all I want to see on Nasdaq is for us to drop down into this order block and go long from there. Compare that to ES, you can see we've actually got SMT on the lows. ES has engineered its low precisely at the 600s, so definitely want to see that get taken out. It's potential reverse on Monday. ES did take out this fair value gap, did take out this 12 AM high, given that S&T on the highs before pulling back. But I am still very interested in a long on Nasdaq from down in this area. So from below this low, ideally from this 10 AM open and lower. So anywhere in this range would be nice for a long. Yeah, that will do for this video. And yeah, I'm going to get dialed in with backtesting some profit taking strategies this weekend.